Hello, everyone, and thank you for attending today's webinar, Investment Trends in South Asia and Southeast Asia in 2023, Navigating New Terrains, sponsored by Apex. We have just a few announcements before we begin. On the left-hand side of your screen is the Q&A. If you have any questions during the webcast, please type your question into the Q&A box and submit your questions to our speakers. All questions will be saved, so if we don't get to answer you, we may follow up via email. At the bottom of your audience console are multiple application widgets you can use. If you have any technical difficulties, please click on the yellow help widget. Here you can find answers to common questions. Or you can type your issue into the Q&A area and we will be glad to offer one-on-one assistance. Towards the end of our webinar, we will ask you to complete our survey found on the right-hand side of your screen. Please take a minute to fill this out before leaving us today, as your feedback will provide us with valuable information on how we can improve future events. An on-demand version of the webcast will be available about 1 day after the event and can be accessed using the same audience link that was sent to you earlier today. I would now like to turn the event over to ASEAN's Regional Managing Director. Take it over, Valerie.
Thank you. Good morning and good afternoon. So good morning to the one who are joining us from North America, Europe. Good afternoon to the one joining us from Middle East and the rest of Asia. It is my pleasure to spend the next 58 minutes moderating a panel on the trends in Southeast Asia. Members of this panel are four distinguished industry players who are representing some of the leading firms in Southeast Asia on the GP side. A bit about Apex. So I'm the regional managing director for Apex in ASEAN, so Southeast Asia. I'm based in Singapore. Apex is an asset servicing firm, and we administer in Southeast Asia both private equity and private credit assets, and in between the two, infrastructure assets. We administer for around $40 billion of private credit assets and almost double value of private equity assets. We've been in the industry in Southeast Asia for the last 15 years, and we work with the leading GPs and LPs in Southeast Asia on the most complex structures. We have developed a few software and application to support us in the service delivery to our clients. So we have completely automated investor onboarding, investor reporting, the portfolio monitoring, the ESG monitoring, the valuation, waterfall calculation, and all that. And this makes us a leader in that perspective in Southeast Asia. We are now really ahead of the game because we are involved in a few pilot projects, both on the private credit side and private equity side. And some of these projects would include tokenization of private equity funds, would also include a dual listing of private credit funds, etc. I will now hand over to each panelist to introduce themselves. And I will start by Sanjay, who is representing Everstone, but he's also the chairman of the Singapore Venture and Private Capital Association. Sanjay, over to you. If you could say a bit more about yourself and Everstone.
Sure. Thank you, Valerie, and a pleasure to be here today and addressing the audience. So yes, as Valerie explained, I am the chairman of the Singapore Venture and Private Capital Association. We are an association of members focused, as our name suggests, on the venture and private capital industry in the region, roughly 250 members, including half being in the capacity of managers within the region and the other being service providers supporting the broader ecosystem. In my day job, I am Chief Business Officer at Everstone. Everstone, for those that are not familiar, is a multi-strategy manager headquartered out of Singapore, deploying capital in private equity. Within private equity, we adopt a controlled growth approach, deploying capital into India and Southeast Asia, and more importantly, into the US, India, Southeast Asia corridor. We deploy capital into real estate and have two sets of strategies. One, where we are the leading developer of industrial real estate in India, and the second more recent strategy where we develop digital infrastructure in India. Our fourth business is a climate impact business, where in its first iteration, we've adopted again a control strategy, largely build out, but some amount of buy and build as well behind the climate thematic in India. And as we roll forward, we will take some of those learnings that we have from India into Southeast Asia. And our fifth and final strategy to speak about is our consumer venture strategy. That's the only thing within the group where we adopt a minority investing stance. We invest in and are very early investors behind consumer brands across Southeast Asia and India. Thank you.
Thank you, Sanjay. Over to you, Andy, if you want to tell us a bit more about Vina Capital and your role at Vina Capital.
Hi, how are you? Thank you very much. I'm the Chief Investment Officer of Vina Capital. We manage about $4 billion in various asset classes, including private equity, infrastructure, real estate, venture, and listed equities. And we predominantly focus in Vietnam. And we do look at countries like Myanmar, Laos, and Thailand. But the low-hanging fruits have been in Vietnam over the years. Vina Capital has been around since 2003. We have a flagship fund listed on the London Stock Exchange out of the FTSE 250. And that fund primarily invests in private equity, and it operates quite similarly like the Berkshire Hathaway. Thank you.
Thanks. And now let's move on to Hoda, who is also a PE GP.
Thank you, Valerie. So my name is Hoda Abujamra, and I'm a founding partner of TVM Capital Healthcare. We are a growth capital fund that invests in emerging markets. We invest in healthcare services. We have offices in Dubai, Singapore, Munich, and Boston. Now in Boston, it's 2:00 in the morning. I hope I can speak clearly at this hour, but yes, thank you for inviting me. And just quickly about TVM Capital, we invest in healthcare services, mainly to take care outside of the hospital. So we believe the infrastructure in emerging market can really benefit from specialty care. We've been investing in specialty care for the last 14 years. And I think with COVID and what's going on, our investment strategy is really validated. And there's a lot to do in our market. I'm based in Singapore myself, full-time. And we invest from the Southeast Asia Fund in Vietnam, Indonesia, and Philippines, and a little bit less in Thailand and Malaysia, but mainly the three markets are the VIP, Vietnam, Indonesia, and Philippines. Thank you very much, and looking forward to listening to all the panelists and getting your question. Thank you.
Thank you. And last but not least, Kanchan, who is representing the private credit sector.
Thanks, Valerie. Glad to be here, everyone. My name is Kanchan Jain. I am the CEO of BPEA Credit. We are an Asia-focused private credit firm, and we focus on Asia ex-China, and more specifically India and Southeast Asia. I think our investment program focuses very much on the mid-market space and the performing credit space within Asia. We've been in the business now for about 11 years. Recently closed our third fund, which is a $475 million fund focused on India, and I think it represents one of the sort of sizable single country funds raised in the region. And I think in some ways represents the sort of change of thought process that's happening with respect to private credit in Asia. I think as everybody knows, historically, there's always been a little bit more of focus on high octane distress strategies, but we're seeing a clear pivot towards the more performing mid-market side of things. And it's something we've always believed to be a larger, more scalable and a more attractive opportunity. It's just really funding and focusing on what we think is the true growth engine of Asia across sectors. We are based out of Singapore, Delhi, and Mumbai, and we are a 30-member team. Excited to be a part of this discussion. Back to you, Valerie. Thank you.
Thanks. So let's now kick off the discussion. So we had our prep call yesterday evening, and the discussion went through different directions. And then this morning I woke up and checked the news, as I do every morning. And I had this feeling that I had honestly for the last 4 years since COVID kickoff, which is again, because indeed for the last 4 years, there have always been a global event which has an impact on all of us, which could be geopolitical, economy, social instability or whatsoever. So this morning the highlight were UBS announcing that 30% of their staff could be made redundant following the Credit Suisse fall. There was also the European Central Bank announcing that there may be a risk of higher interest rate. There was also China expressing some concern about the slowdown of the global factory activity, etc. So question to each of you, with all this unexpected and disruptive news that we hear about almost on a weekly basis, what is your sentiment as manager in Southeast Asia? Are you more on the optimism side, pessimism side? Do you see opportunities in this global turmoil, or to the contrary, are you more, let's wait and see? Let's start with you, Sanjay.
That's a rather wide topic, Valerie, that you put forth. I think, listen, as investors, part of our job and part of the reason that our investors pay us is to navigate what's happening. Now, we do live in a fairly complex environment, and just as you said, over the last few years, first we had the pandemic, and then we had a fairly strong fiscal and monetary response to the pandemic, which fueled a certain flurry of activity. We then went into a stage where, following the very unfortunate Russian action in Ukraine, coupled with the tensions that were building up between the US and China, we've had a bit of a geopolitical stance shift as compared with the last 2 decades. And then we've had the entire monetary tightening and the more recent events around SVB and thereafter Credit Suisse, etc. So lots to unpack out there. And clearly we need to be watchful in the very near term. There are certain implications in the very near term around capital flow, around deal making, around financing, costs of financing, exits, etc., that we all need to be prepared to be tackling on a very considered basis. But if you were to just step back, and since the topic of this conference today is more investment trends in South Asia and Southeast Asia, the reality is that in the global context, this is the bedrock of growth on a go forward. I think as you look at different forecasts, India is slated to overtake Germany and then Japan to emerge as the third largest economy over the coming decade. And ASEAN collectively is again slated to overtake these two economies over the coming decade to emerge as the fourth largest economy. So even as we bifurcate a potential polarization from a global standpoint of capital flow, the US and China as largest and second largest, the reality is that our region will be home to the third and the fourth largest economies, and therefore be attracting a fair bit of capital flows. And that's the more optimistic way that I would look at the broader landscape.
Sanjay mentioned India being one of these maybe country which seems to show which seems to carry a lot of hope or expectation from global investors despite the turbulence. Would you agree? And again, what is your perspective? Are you more on the optimist side or the careful side?
I think the simple answer is yes, I would agree with Sanjay. But in terms of just the overall perspective, I think the key thing for us is we're all part of this environment. But I think the big thing we notice is the regional divergence in terms of the implications of these events, right, on the individual economies as well as the investment landscape. And I think the big one there is just looking at what's happening with the banking sector, right, with the recent events with SVB and Signature Bank and Credit Suisse, is that the risk of contagion, of these events in the US is far higher, right, than it is in Asia Pacific. And in some ways, I think, that also goes down to, other things, China opening up, right, which is easing out some of the supply chain issues that we've all been facing for the last couple of years. Again, I think is a bigger plus. The commodity exporting economies of Asia, the travel, dependent economies of Asia in some ways will benefit more. So for us, the regional divergence between implications of all of these things on the US and European markets versus on the Asian markets in some ways is a key theme that's emerging out of this. And I think in all our LP discussions, as well as discussions internally, I think the key is to recognize that. I think gone are the days when we say, Asia is an emerging market, I need an absolute amount of X hundred basis points of premium. I think that's a bit of a losing proposition. I think the winners would basically be people who look at Asia standalone for what it is and identify, trends that are going to benefit from a lot of, what is happening, and then, figure out a strategy for investing in that. So for us, that's an overarching sort of principle in terms of how we're looking at the investment landscape and how we're thinking about our strategies. Just specifically on India, that's absolutely right. I think the amount of interest we've got from global majors, both in terms of setting up investment shops in India or targeting capital inflows into India has been significant. And likewise, in terms of the prospects we are seeing in the economy, both because of trends relating to supply chain diversification away from China or just domestic reforms and sort of incentives are robust, still very sustainable. So I would completely agree with the level of interest that we are seeing and feel it's justified.
Hoda, you're covering North America, Middle East, and Southeast Asia. In addition to India, would there be any country in Southeast Asia that you think are really promising in terms of investment opportunities for this year and beyond?
Thank you, Valerie. I agree with everybody, and I'm not going to add what they said, but one of the things that is, I think, a trend that is the most crisis-proof is healthcare. So investing in healthcare is always needed. So times like this are not bad for healthcare investment. And the truth is also in Southeast Asia and everywhere, the valuation have been kind of a little bit crazy in the past couple of years. I think this is a time when you have the money to invest, is the right time to invest because the valuation discussions are very good in general in all our markets. And as you know, COVID highlighted that our healthcare system really need some improvement and need to be more sustainable. So there's a lot to do. So for somebody like us in growth and in healthcare, it's a perfect time to invest. And I believe will be the best vintage year.
Andy, so your firm is focusing more on Vietnam. But in addition to Vietnam, could there be any other country in ASEAN that you think, as I asked Hoda, are promising? And if it's only Vietnam, why do you think Vietnam is getting so much attention?
Yeah, I think, looking back at what's happening around the world, we can say that the crisis in the European and US banks have, one, depressed the value of the US dollar. The DXY has come down. Two, it has created a situation where we may pivot from increasing interest rate environment to beginning to see a stabilized and declining interest rates. So that's all very interesting for Southeast Asia and emerging market. Our chief economist thinks that it'll begin the flow of investments from Europe and the US into emerging market slash frontier market. Now, within Southeast Asia, I think we have a couple other things to consider. One is the China-US trade war. It has been going on for a while. And now, in addition, there seems to be a bit of tension between China and the US, both of which has pushed a lot of multinationals and Chinese manufacturers to diversify away from China. They are going to, I think, predominantly Indonesia and Vietnam. I think it's because, one, they can find a large labor force to work it. Two, the political situation seems to be stable. I want to use the word seems and not caveat that a bit. But labor costs and the logistics, the ports, the roads seems to be quite positive. And the government continues to invest in the infrastructure. So that allows these two countries to benefit from the diversification of manufacturing away from China. And I think the other countries, the population is simply a bit smaller, or it's a bit more developed, or the cost of labor. I think labor cost is one of the key components in which these businesses choose to diversify away from China. So as it relates to investment, it does create an exit opportunity for us as businesses come to Vietnam or anywhere in Southeast Asia for that matter. You have large conglomerates like SK or GS Energy or Indorama, which just sold a massive business to Indorama out of India/Thailand. And so it creates an exit opportunity for some of our investment. It also forces us to think about as time goes by, the next 2, 3, 4, 5 years, what kind of businesses we ought to invest in so that we can sell it to these strategic folks that come to a place like Vietnam or Indonesia, Southeast Asia. Now, the difference between now and about 3 or 4 years ago is, I think, interest rates. Interest rate is causing, when the interest rates was low, the patience to grow organically wasn't there. People were willing to pay to enter a market, to buy a business and enter a market. So it created exit opportunities for us quite easily. Now that interest rate is higher, the cost of funding is higher, I think there's been a slowdown in strategic acquisition and a rethink of whether some of these businesses, when they expand to Southeast Asia, they ought to grow organically, or should they continue on the path of acquisition? Because fundamentally, their cost of capital has gone up quite a bit. And so that also forces us to think about IPOs more, listing the assets more so than just selling the asset to strategic buyers. On the subject of healthcare, we are a very big investor in healthcare. We created one platform and we sold it to Fortis Healthcare out of India already, and we have 2 platforms in our portfolio right now. Each platform is about 5 to 6 hospitals. My caveat in healthcare is it is a very interesting sector to be in because everyone's getting older and you need medicine, you need healthcare, etc. But I have to admit, a lot of these businesses keep quoting to me their EBITDA numbers. Whenever a business quotes to me EBITDA number, it begs the question of whether they make a profit or not. And frankly, the healthcare businesses are being valued on an EV to EBITDA basis. And we have a lot of interest, don't get me wrong. We have a lot of interest to enter Vietnam from regional hospitals, international hospitals to come in and access the market. But the market is very frothy. It is valuable. People are valuing businesses on the EV to EBITDA basis, and they're taking controls of these businesses. Our job is to make sure we can roll up these hospitals, put it into a proper platform, put the corporate governance together, the environmental, the ESG matters together, and be able to turn around and sell it to a strategic. So overall, there's a lot of exciting things happening in Southeast Asia, as well as Vietnam and Indonesia. And there is a trend to look at Southeast Asia as a new manufacturing hub to diversify away from China. But the challenge is we do have a high interest rate environment. And if this environment continues to be high in terms of cost of funding, then acquisition activities will probably slow down, and we'll have to look at IPO as an alternative route to an exit.
Thanks. So if I was really summarizing your input, so what I hear from the four of you is that in terms of country focus, India, Vietnam, and Indonesia are definitely the winners in current market conditions. And in terms of sector, I've been hearing a lot about healthcare. If I deep dive into the sector, maybe a question for Sanjay and for Kanchan. Could healthcare be the only sector that you would be looking at in the next 24 to 36 months? Are you actually maybe more open to diversify your sector strategy?
So let me take that in a few ways, Valerie. As I made clear upfront, we as a group are deploying capital across a few strategies. As I deep down onto our private equity strategy, yes, healthcare and pharmaceuticals alongside is a very key component of what we do, and is a major sector for us. In fact, we have two sectors that account for close to 80% of capital that we deploy in private equity, which is healthcare and pharmaceuticals and technology services. And even as I dissect what we do in technology services, which is largely aimed at the US and other Western markets in terms of our ultimate clients, the underlying out there also tends to be healthcare. So to answer your question differently, yes, healthcare is a key thematic. Healthcare is a very defensive sector, very resilient sector. And in addition to its defensive characteristics, broadly speaking, in the context of South and Southeast Asia, where there has been historical underpenetration, especially of organized healthcare and pharmaceuticals, coupled with growing populations, this is a sector that will continue to do well. Now, does that mean that healthcare is the only sector? Clearly not. So we, for instance, deploy a fair amount of capital. In fact, similar to our private equity business, we deploy a fair amount of capital behind the broader climate thematic, both the decarbonization thematic through renewables. We have large mobility businesses, large resource efficiency businesses, etc., which also have very strong underlying characteristics. I'd say that the key really is that within these broad growing Asian markets, and yes, there is India, there is Vietnam, Indonesia as the three big picks, but not to take away opportunities in some of the other Southeast Asian markets. There are a variety of sectors. I think this panel has not spoken about the entire growth that fintech, for instance, has witnessed, or what financial services in general across these markets witnesses. Now, is there a point to make that there is no investment opportunity out there? Clearly not, right? What really matters is being focused on certain industries that you understand, where you can bring nuanced value to play, and taking those forward. And I've just named two, not to take away from many other sectors where there are exciting opportunities.
So adding on to that, I think I agree with Sanjay. In fact, I think our experience has been that our investments are in a sort of pretty sector agnostic approach across various sectors. Our own findings are that requirement of growth capital or underpenetration of capital is actually prevalent across sectors, especially say in an economy like India, and I think also by extension in a lot of Southeast Asia. I give you an example. Our own proprietary research over the last 10 years has shown us that while at the top, mid-market accounts for about 40% of overall sector output, once you break it down in terms of sectors, 3 out of 4 sectors, we've seen that mid-market is a dominant contributor to the sector output. And I think the phenomenon at work here is, and I've spent 10 odd years working out of London. When we think of $100 or $150 million company in Asia, I think in some ways, the dollar equivalent numbers underestimates the market presence of this company, right? At that level, at that size, you're looking at a company that's been built over 20, 25 years, potentially has market leadership across, its market. In India, if you are a market leader in South India, you're addressing a population of 300 million, right? So across these sectors, and the second interesting thing is that, as we are looking at most of the economies growing in India, for instance, services is about 50-55% of the GDP, and yet accounts for less than 25% of bank credit, right? So I think these are the trends of under-penetration of credit, under-penetration of private credit is prevalent across sectors. So for us, most of the interesting sectors, most of the sectors are actually quite interesting, but to name a few, business services, infrastructure services, across a range of infrastructures, logistics, warehousing, all kinds of manufacturing, renewables as a big sector. I think all of these are growth sectors, and we see a lot of opportunities across that. I would say the only sort of sector that we stayed a little bit soft on for almost most part of the last decade has been the consumer side. We've seen the consumer sector sort of come back in a bit of way, again go back, and I think we still remain very cautious about it. But outside of that, I think a lot of the sectors, present really interesting opportunities.
Thanks, Kanchan. Let's maybe now spend the next 10 minutes on investors and capital raising. You had shared very interesting data, Sanjay, yesterday on our prep call regarding the capital raising activity globally and the drop, obviously, in the last 2 years. And you had also made very interesting comments with respect to the impact on Southeast Asian GPs. It's something we hear on the daily. It seems that first-time managers, startup managers are the one being more impacted by these capital raising challenges. We also see some middle-sized firms who have been postponing the launch of their funds, and sometimes over a period of 18 to 24 months, which is significant. And it seems that the only one who continue raising capital at the same pace as pre-COVID are really the global managers. Do you want to share a bit more on this, on the capital raising challenges and your perspective, Sanjay?
Sure. Thanks for that, Valerie. So let's, first again take a more macro point of view. And I just came across a recent McKinsey publication, their private capital report for calendar year 2022, which spoke about a general drop in fundraising within private capital globally, barring a few subsegments. And as they presented the numbers for Asia, there was virtually close to a 50% drop in private capital flowing into Asia. Now, a large chunk of that was, of course, linked to China, given that China accounted for a large share of private capital flows into the broad Asia region. But it had follow-on impacts on other parts of Asia, because purely from a Western institutional LP standpoint, China was their mainstay for Asian exposure, and a lot of people took perspective that if not China, why bother with the rest of Asia? Not to say that everyone took that point of view, but a number of people took that point of view. So that's one trend which we've seen, and a large chunk of the explanation of that trend can be put into two broad buckets. One is overall global slowdown, which is linked to people's own portfolio allocations, where because private capital has outperformed other asset classes, both public, fixed income, and others in people's portfolios, private capital became over allocated. So there was some amount of rebalancing on that count. And the second has been the entire China dynamic, where there has been a slowdown and the follow through impacts of that. So that's one big trend. And within that trend of lower flows, clearly there is a rush towards perceived quality, and I'm very consciously using that terminology of perceived quality, which comes with size. And yes, the larger managers, the more established managers have attracted the large chunk of those flows. So that's one dynamic, and we have to see how that plays out as China reopens, as a lot of the stress that is happening in the financial markets globally, how that plays out. We have to see how all of that pans out. As I step back and I look at just our region and with what's happening in Singapore, and as part of my role with SVCA, I'm also on the executive committee of something called the Singapore Funds Industry Group, which is an MAS public-private initiative. We get access to certain data points which are indicating that on a more generic basis, flows into this region are growing very healthily. Flows through Singapore into the region are growing very healthily, and the last 5 year kind of CAGRs out there are very impressive. Some of this is flows coming in, or a large chunk of it is flows coming in from institutions. Uh, Now, it's not only the American institutions. The Canadians are big investors in the region. The Middle Easterns are big investors. The Koreans, Japanese, Australians are all big investors in the region. And so that's one facet of it. The second is the entire facet around family offices and private wealth. Now, we know that the share of wealthy in Asia per se has been growing up. The number of people getting themselves institutionalized into family office formats is growing up. The official statistic is still to be released, but if memory serves me right, at the end of 2021, it was close to 700 family offices that have been registered in Singapore. And I think that number is tending towards 4 digits now. So that is also becoming a source of capital flow, a source that traditionally did not necessarily invest into private markets, but is now increasingly looking at private markets. So we have to bear that in mind as well as we look at the broader fund landscape on a go forward.
Thanks, Sanjay. So, Huda, you are currently raising capital. Have you been facing some of the challenges that I've briefly mentioned and Sanjay has elaborated on? What is your experience so far?
Valerie, I agree with Sanjay, and yes, we're facing the same exact challenges he mentioned. But also, I would add that there's a lot of also development money that is looking at our region. There's a lot to do in our region, not only in healthcare that is very impactful, but also in other verticals. So development money is still there and still getting deployed in our market. And I think for a lot of us, this is one of the the investors that could make a big difference in the stock markets. Because we can do a lot of impact and at the same time return because of the growth of the market we are in. But yeah, with institutional investors, we see that a little bit. We were hoping in the beginning, as Sanjay mentioned, that the money that stopped flowing to China to flow into Southeast Asia and other markets, but it's not yet the case.
Thanks. Andy, being country-focused GP in current capital raising tight market, do you see it as an additional challenge to not be offering pan-Asian opportunities to your prospect investors?
Yeah, I think there are challenges at the moment, particularly from capital coming out of North America and Europe. But we are seeing a lot of interest from North Asia, South Korean, Japan, Taiwan. There's a lot of money coming in China. There's been a massive amount of family offices being opened in Singapore, and they're looking for places to deploy capital. And so I think in general, the traditional base of capital that flowed to Southeast Asia and Vietnam, being North America and Europe, that has sort of minimized, or not minimized, but slowed down a bit. The interesting part right now is we're seeing a lot of interest from North Asia, China, etc.
And Kanchan, so in private credit, it's one of the sector which seems to actually attract most of the capital today in Southeast Asia. So when I look at the different statistic and report from different organizations, there was a specialized private credit conference organized last week, and I was attended, and the number of LPs from North America and Europe attending this conference to identify Asian GPs specialized or focusing on private credit in Asia was really impressive. Could you also witness that and share that or agree that private credit is maybe the asset class which is slightly suffering less of a capital raising challenges?
Yeah, I think that's absolutely the case. In fact, the same report that we are talking about, while the fundraising numbers overall have dropped, I think private credit is the only asset class where there was a marginal increase or a flat, kind of growth in the private credit fundraising numbers. And you're right, there were a lot of managers, a lot of LPs that had come to the conference, last week, 2 weeks back, and essentially they were first-time LPs or first-time visitors, to Singapore, looking at the opportunity. And I think our own experience is that, and this I alluded to this a little bit earlier, that what we are really waiting to see is potentially a big, unfolding of credit pain or pain in credit portfolios, but more so in the US. Right? This kind of tightening of 400 basis points in 12 months is completely unprecedented. 30% of US market is speculative grade. S&P rates about $1.2 trillion of speculative debt, and most of that is in the US. Another 30% is actually BBB category. So as you take the impact of, you consider the higher leverage that's there in the US, about 5 to 6 times. Most debt is floating rate debt. There is a massive slowdown that's happening or expected to happen in the economy. I think that level of pain that you're potentially going to see in the US is also what is seeking, a lot of, getting a lot of LPs seeking for a different risk and return profile. And I think in some ways, Asia offers that, right? And we spoke about this briefly yesterday. When we think of the amount of leverage that's there in the system in Asia, it increases as you go towards East Asia, right? Indonesia, India, you're looking at about, 40 to 60% corporate debt over GDP. By the time you get into Japan and Korea and China, you're sort of 120 to 160% plus. It's a very different ballgame. Fundamentally, the trends I think that you would take advantage of, if you're looking at Asia, is under penetration of credit, period. Under penetration of private credit, right? And you have a number of sort of sectors and companies, and fintech sector is one where we are seeing again a lot of opportunities, where there is a true need for capital. So what you otherwise get concerned about, I think the institutional weakness that you potentially see in Asia when you invest in private credit markets is sort of adequately compensated for the fact that you're looking at much lower leverage ratios. You're looking at anything from 3 to 4, 4.5 times at max. You're looking at a lot more cash flow based investment opportunities, that you can access. You're looking at higher growth economies, right? Higher growth sectors. And I think all of that, there is a true realization with the number of LPs that are now, talking to us about looking at Asia on the credit side, is just acknowledging that there is a very clear divergence in terms of how the next 12 months could go for credit markets. And I think that's the reason why we are seeing a lot more interest in the private credit space in Asia. And I think even Asia as a whole, while at the top you see a big drop in fundraising. If you think of Asia ex-China, it's actually remained relatively flat, right? And I think considering what has happened in the last 2 years, that is, it will take some time before you get to a stage where the capital that was flowing into China, we start to see in India and Southeast Asia. The markets are not that big to absorb that amount of capital. But the fact that we've had a lot more interest and it's remained flat is a step in the right direction. So for us, there's a lot more interest, in the private credit space. I think at some level, what's happened to portfolios in the US will have implications. The over allocations of the private markets, given the public markets have gone down, is very real. So I think it may be a little bit more of LPs that are already, aligned to invest in Asia and now looking at other parts of Asia, other asset classes, as opposed to complete new LPs instantly moving and allocating to, Asia in the next 12 months.
Valerie, can I add something quickly that somebody mentioned? I think Sanjay or David, about Middle East. So there's a lot of cash there, but it's not a traditional place. A little bit like when you mentioned Japan or Korea. Unless people know that market, it takes a long time to really court investors there. The same thing in the Middle East, but there's a lot of money looking at Asia, surprisingly. China, of course, for a while, but now they are looking at Southeast Asia, and specifically Indonesia and Malaysia. So this is a source of capital. I mean, we've been based there for 12 years, so it's easy for us, but it's not an easy place to usually to look at and bring capital. But this is another place that have a lot of liquidity and is looking at Asia, actually. Yeah.
Thanks, Huda. So with this fierce competition to raise capital from what I understand, the same pool of institutional investors and family offices, then question is, how do you differentiate yourself? Maybe a question to you, Andy. You've been mentioning, the importance of successful exit earlier in the discussion. Yes, is the performance and the ability to exit quickly and to exit successfully really the main differentiator for you to convince investors to allocate capital?
Yeah, I mean, clearly, we all have to sort of differentiate ourselves in this day and age. And one of the key components when it comes to asset management is return. If we look at the history of our firm since 2003, our private equity, on an average since then, has delivered 21% average on a gross basis since the very beginning. And so we've been quite successful to that end. But I think one of the key differentiator is the scale. Although we operate in for lack of a better word, a small pond in Vietnam, we are a big player in a small pond, and the scalability helps significantly in terms of accessing deals, in terms of negotiating downside protections, veto rights, corporate governance, board seats. So the terms of investment is extremely important. And it dictates how successful or not successful you will be upon exit. For example, if your terms do not have proper drag-along rights, commitments to list, it makes your ability to exit significantly harder. So having scale and experience helps us differentiate ourselves from our competitors in terms of getting into deals, but more importantly, in terms of getting out of deals. I've seen too many situations where investors come into a minority position and get stuck. And the only way they get out is to negotiate with the sponsor to buy back their shares, and the sponsor will pay you roughly bank interest rate plus a margin, and that's it. And so I think the key is that we recognize how we should exit these assets. We recognize that having scale is important, and that helps us differentiate ourselves against, not only competitors locally, but globally. We have a lot of global players coming into the region, and we have to be able to ensure that we can access these deals. The competition comes from not only accessing money from abroad, but also accessing deals in the country. So there's competition at both ends of the spectrum.
Thanks, Sandy. Hoda, same question to you. You mentioned earlier that development bank or development organization, European development organization and bank were usually quite eager to invest if there is an impact or ESG element. Is it how you differentiate yourself to convince them again to allocate to TVM Capital?
Thank you, Valerie. For us, ESG and impact is part of, especially ESG, is part of doing business or risk mitigation. So it's something that is so important to be able to create a strong and sustainable asset. Impact is also big because to create healthcare infrastructure and sustainable asset, you have to be impactful and you have to create it in an impactful way to help and support and address the middle class and also the population that cannot afford. So it's a lot of challenges, but it's a lot of opportunity because this is where the numbers and the mass. We also don't invest in hospital because we believe everybody invests in hospital, everybody that have $1 billion fund. So we're a small fund and we look at opportunity that have a lot of growth potential. And I agree with Andy, you need to have control position because if you go into assets, especially the way we go into smaller asset and we roll our sleeve and we operate, and as you said, to create an impact, you really have to create a very strong base and very well governed and run company. You have to be in control. Otherwise, things will not work the same way and you will not create a good base for growth. So for the differentiation, and I think everybody's also trying to do the same, is we are specialty investor. So we have a global network, but at the same time, we have execution and operating expertise in every country. Healthcare is very local. It have challenges with regulatory, it have challenges with reimbursement. So you need to be able to manage and mitigate those challenges. And the third challenge is also access to good human resource. So having been doing this for a fragmented market for a long time, we've learned how to mitigate these risks and how to create good return. We have similar return than Andy. We were able to give 20% net IRR while we're doing an impact and while we're focusing on a lot of the important things. So I believe in healthcare you can make money and make a difference and do well and create an impact together. So and I think in our market there's so much to do in creating the healthcare infrastructure outside of the hospital, so more specialty care, that for the next couple of funds, there will be a lot of good opportunity and also good exit. As Andy said, the market is there's a lot of liquidity. So if you create a good asset, well run, and have a growth potential, exits are there and the money is there and strategic also. So when you're very specialized, not only you have the financial buyers and the IPO, but you have a lot of strategic that are looking at the market globally from Asia and everywhere else.
Thank you, Hoda. And for the last 5 minutes, Sanjay and Kanchan, similar question. How do you differentiate yourself in such competitive environment? Kanchan, maybe first?
So, there's no substitute for investment performance and track record. And I think ESG is now very core, a necessary thing to have. I think to add to this, and maybe again quite relevant for private credit space, sourcing engine is something that we have seen becoming a big differentiator for us, right? For us, a deal pace of 15 to 20 and sometimes more investments in a particular year. And what you're sourcing are sort of more classic mid-market, investments. Having a sourcing engine, is becoming one of the key sort of differentiators and things LPs are looking at. And what we've realized is it's not something you can build over 1 year or 2 years. For us to now have an intermediary base of about 200 pan-India basis and about 50 or for Southeast Asia, and we're not looking at the big four, the large banks. This is a very specialized, kind of intermediary network. I think it's taken time to create that. And I think that for us now becomes one of the key differentiators, in addition to things like performance and track record and having the right team, and all of the other good things that's necessary, for today's capital.
Thanks. Sanjay?
So, listen, I think the other co-panelists have kind of outlined points that I totally agree with. First and foremost, investors are concerned about returns and your track record of both returns on paper, but more importantly, your returns of distributions back to LPs. That takes center stage. But that being said, I think people will look beyond that into your credibility as an investor, and that has got multiple dimensions around your credibility, keeping aside the risk factors and the reputational risk factors. I think all mature firms will have very strong risk management processes, and I would take ESG as a subset of risk management processes based on the underlying strategy. We have very strong impact management and measurement frameworks in place, more specifically for our private equity business as well as our climate investment business. But I'll keep that aside. I think what's important is, are you two people operating out of a shared workspace, or are you an institution? And increasingly, people want to be dealing with institutions. Not to say that there is no room in the market for two people out of a co-working space, but maybe that's more at the very early stage of investing. For more mature categories, you need institutional frameworks in place. You need proper middle and back offices in place. And importantly, you need a staffing structure both within the investment team as well as your network of operating partners and other experts, which are in tune with the underlying investment strategy. So if today we, in our private equity business, focused on healthcare and tech services as the two dominant sectors, it has to be married with the strength of our full-time investment team, as well as the strength of our operating partner and expert network. So there are multiple dimensions to it, but yes, the starting point has to be what have you delivered for your LPs.
Thank you very much. We still have 2 minutes, so if anyone in the audience has any question, you can still post it through the Q&A box. We had a question from Ashok, and it was about a capital raise in SEA. I think we answered the questions. So if there is any other questions, you still have 2 minutes. The session has been recorded and will obviously be available through the different super return platform as well as through LinkedIn. Each of the panelists' contact details will also be available through Super Return or Apex. So if you want to extend the discussion with any of them, please just drop Super Return or Apex a line, and we'll make sure to connect you to the panelists. I cannot see any further questions, so I will just thank everybody on this panel. It was a pleasure to spend the last hour with each of you. Thank you for being so open. Thank you for also opening our eyes on some of the challenges in the market. And I look forward to having another opportunity to discuss with you these topics during the rest of the year. Thank you.
Thank you.